In this video, we will discuss why the value of rupee depreciates against the dollar. You see, it's a game of supply and demand. For a country like India, we import much of our valuable commodities like crude oil, gold, or electronic goods. If we import more than we export, we create a trade deficit, which is one important reason for rupee depreciation. Let's understand this with an example. If an Indian oil company like IOC wants to import crude oil from a Saudi oil company like Saudi Aramco, first there will be a deal that how much quantity of oil is needed and how much money should be paid for them. Let's say IOC is importing around $100 million worth of oil. So first IOC will contact its bank. Let's say it has an account on SBI. So IOC will tell SBI to transfer that $100 million to Saudi Aramco's account. Now State Bank of India, first they will debit that $100 million worth of rupee from IOC's account, and they will use their own dollar reserve to pay the money to Saudi Aramco. Or if they don't have that money, they will go to the forex market and they will buy the dollar from them. Once they have collected all that money, they will transfer that money to the Saudi Aramco's account. Now you can see that in this transaction, the $100 million which was in State Bank of India, that $100 million was in our bank, that $100 million was transferred to a foreign company's bank. So that $100 million was pulled out of the Indian market. So when we import more commodity, more dollars are pulled out of the Indian market. This creates a downward pressure on the Indian rupee. So therefore the rupee value depreciates. Next is foreign investments. You see, India is the fastest growing economy in the world. Foreign investors invest in India to seek higher returns. But if the Indian market underperforms, or if they get any hint that instead of investing in India, there is a bigger opportunity in the US, or if there is any geopolitical tension like the brief war with Pakistan in 2025, investors usually pulls money out of Indian market and invest in the US. When they pull money out of Indian market, what happens is that the dollar reserves depletes from Indian market and the Indian market are flooded with rupees. This also puts a downward pressure on the valuation of rupee. Next is tariffs. US has put a 50% tariff on Indian goods. So what happens is that when the US puts tariff on Indian goods, it becomes more expensive for the US customer. When it becomes more expensive, its demand decreases. The demand for Indian goods decreases in the US, and since demand decreases, less amount of Indian goods will be exported to the US. So when less amount of goods will be exported to the US, less amount of dollar will flow into the Indian market. If we cannot sell anything to the US, we will not get its dollar. But India needs dollar. We need dollar because we import much of our valuable commodities. And since the flow of dollar decreases, but our demand for dollar is static or it keeps on increasing, this too puts a downward pressure on our rupee valuation. So the conclusion is, to keep the money value stable, we need dollar. If the dollar is depleted from our Indian market, then it puts a downward pressure on the Indian rupees.